Hi everyone, Jeff Yasteen here. So welcome to my first mailbag video. So I'm reading a couple of emails here and send me more at this address, jeff@yasteen.com. Follow me on Twitter and on Facebook as well. Okay, so the first email is from my friend Tom. And before I read it, I'll give you the backstory on his email. A few days after the presidential election, I did a paid subscribers only presentation on alternative energy stocks I liked. And I mentioned a highly speculative next-gen battery technology company called Quantumscape, which now trades under the symbol QS. Now it has no revenue, it has no actual product to sell yet. What it does have is patents and research on a new kind of battery that recharges much faster. It'll be years before they can fully commercialize the product. It's always a very risky venture. But what I had found intriguing is that one of the company's board members is Tesla's former chief technology officer, and the other backers are Volkswagen and Bill Gates, among others. Anyway, so flash forward 3 weeks ago, and the stock soared more than 269%. Oh, it's great when that happens. But having said all that, please do not go out and buy the stock after the huge run. As I said, it's highly speculative. Stifle your urge to buy. No doubt you'll have plenty of chances to buy it if you still want to when things cool off in the broader market a bit. But back to my friend Tom, after watching my original presentation on November 6th, he did go out and buy a little of Quantumscape's stock, and this is what he writes. I really enjoy your videos and commentary on the markets. Your knowledge and experience and common sense are so welcome. I must thank you for pointing out the stock on your show several weeks ago. I was intrigued by it and bought it at 14, and you have given me a great return in a short time. So Tom, thank you for writing in, and of course it's great to read your email and have a great experience like that. And it sounds like Tom wants to hold his stock for the long term, and as he pointed out in his email, I didn't read that part, but it's only a small position in his portfolio. So we all have to make our own personal decisions on these sorts of things based on our own time frames, the size of our portfolios, our financial goals, and of course our tolerance for risk. So we just have to remember that highly speculative stocks like these, or any stock, can move sharply higher, but they don't always have to hold these high prices. And when they get going, they really get going higher. The challenge is, of course, we don't know when or how quickly they cool off. And that's why, these kinds of things are high reward, but also high risk. So it's also a judgment call, as far as taking the easy windfall profit now or hold on in the chance that a stock like this one keeps working its way higher and higher over the course of, months or years to become the proverbial next Tesla or next Netflix. And of course, we never know on these sorts of things. So the next email is from my friend BP, and he has an investing question, and it's a great one. And he writes, how do I hedge my portfolio to remove or greatly reduce the risk of owning FANG stocks or any stocks? So BP, that is a great question. And in some ways, it's easier said in spirit or answered in spirit than accomplished in reality. But it's worth answering here because, many of us own a lot of FANG stocks, Facebook, Apple, Amazon, Netflix, Google, and they've had a great run the last few years. So the simple answer, BP, is that you really only have limited ways to hedge your portfolio. You can reduce your risks, but doing so, like everything else in the stock market, carries its own cost. So there's no simple, clear-cut answer that I can give you, but I'll try, all right? Number one, true hedging is just hard to achieve, but I know some people who use options. They'll buy deep out-of-the-money puts on some of their biggest tech stocks, and if those stocks happen to collapse quickly, in theory, their options will soar in value, offsetting the loss in value of the stock itself. But option strategies like that, if you're doing it for months or for years at a time, it becomes a big cost. It's like owning an insurance policy on your car or house. And if you don't keep paying the premiums, the policy goes away and you've just wasted the money. If the stock falls and then you decide you want that insurance policy, it becomes very, very expensive, if not impossible. And I should point out that's also why so-called bear market ETFs, these are exchange traded funds that are designed to go up when the market goes down, almost always constantly lose money except for the brief periods over a few days or a few weeks or a month or two where the market goes down really fast, in just a very short time. So number 2 here, you can lighten up somewhat on your FANG positions, maybe 10 or 20%, and keep that money as cash in your account until the next correction or bear market comes along. Now, in theory, you are selling high, but at a later date, you're planning to buy low. So the cash acts as a hedge in your account. And when the rest of Wall Street is panicking, you can take your time and buy, great stocks that are being given away at cheap prices, if you have the patience to wait for it. But keeping large amounts of cash on the sidelines is a somewhat controversial idea. Portfolio managers, for instance, are paid to stay fully invested at all times. But, they have more money coming in every week from people like you and I when we send in our 401k and IRA contributions. On the other hand, an investor like Warren Buffett, he keeps massive amounts, billions in cash on the sidelines. Now, some might say that's far too much, but he knows that the best time to put that money to work and get the best long-term return, looking out 5 years or 10 years, is to wait, be patient, and only make those big stock purchases when stocks are truly cheap. And those moments, only come around every few years or sometimes longer. But that's when he knows he can strike and get truly great deals, that the math makes sense. So number 3, you can lighten up on your FANG stocks and use the cash from those sales now to buy stocks in beaten up sectors that are already way down from a handful of years ago. All right, this is the strategy that I've been using in small ways in recent quarters. So we're talking about buying banking and insurance stocks, which are way down. Oil and pipeline stocks, which are up a little bit in the last few weeks, but are still way down from over the last few years. And emerging market stocks. Some people think gold and mining stocks are also something of a hedge, though that too is a somewhat controversial topic where people have a tendency to disagree. Keep in mind also that having a hedge does not mean that you don't lose money. In a bear market or true panic, all it means is that maybe, if you've made all the right choices with a little luck thrown in, that your hedge stocks go down less than your FANG stocks or whatever the momentum stocks are that you own, and that when the panic selling eases, those stocks will go up faster. But again, that is the theory, doesn't always mean the reality matches up. So number 4, the last strategy, is really not to hedge at all. One thing to remember about dominant, well-run companies, Facebook, Apple, Amazon, and Google are certainly that. They all generate massive amounts of cash just with their own businesses. So if we hit a bear market and their stocks do go down 20 or 30, 40%, those companies can then put that cash to work buying back their own stock. Each share they buy and remove from the market makes all the remaining shares that we own a tiny bit more valuable. So share buybacks can be a powerful force in boosting a company's stock price over time. Not days or weeks necessarily, but over quarters and many months and years. The other thing is to think about dividends. Apple, of course, pays a dividend. So it can raise the payout level of its dividend to make its stock more attractive and bring in more buyers, more investors. And while Facebook and Amazon and Google do not pay dividends, it's possible they might choose to do so in the future, just like Microsoft did in the wake of the dot-com bust 20 years ago. And people tend to forget about that. But when Microsoft chose to start paying a dividend was in the midst of the dot-com bust. And if we remember, Microsoft stock did go down. In fact, it went down 70% in the lows of the financial crisis of that era. But look where the stock is now. It's come all the way back and taken on many times more profits beyond that. So BP, just to summarize things, hopefully you've seen that all of these sorts of strategies have their own potential rewards, but also have risks as well, and of course costs too. So they're all things that you have to keep in mind when making a decision regarding the stocks, any stock in your portfolio. I'll be back next week with more videos, and of course I hope to bring you more mailbag videos in coming Saturdays as well. I'm Jeff Yasteen.